There you are. You're
Okay,
live now.
we are live. So I'm going to call this meeting to order. The Senate Finance, this is April 20th. And today we're going to take testimony on the PPP taxation. As 315 went through, it contained a provision that there would be no taxation during this tax year, 2020, because people had already started filing. But next year, there was some concern expressed by the Joint Fiscal Office that not only would the grants be tax-free, but the expenses could also be deducted. And so I think that both committees, House and Senate, just wanted some time to take a look at that and to take a look at base state funding, which is still very tight despite all the millions or billions of dollars which are floating around. So that's where we are today. We just wanted to hear from businesses, hear what this means to you, what's important, and then we will continue to work on this subject. So first is Austin Davis from the Lake Champlain Regional Chamber of Commerce. Up, Senator Pearson.
Madam Chair, I just want to stress, because it's been presented in the media and certainly it's reflected in the dozens of emails we're all getting, that we made a decision, and now maybe people are here to help us make a different decision. And I think it is more accurate to say we postponed this decision so that we could do it. We were kind of under a gun because Congress acted late on 2020 and we didn't have any choice. So I just want to set the stage because I hope people won't feel they need to convince us to change our minds. We just reserved some time to make this 2021 decision. So I wanted to make that clear.
We were under a lot of pressure. These changes came November, December. The forms were printed, people were filing. We made a decision for this year, but really we're just trying to buy some time before making a decision about next year. So with that, Austin, there you are.
Madam Chair, may I also add something to that discussion?
Yes. Yep. Senator Brock.
It's not that we didn't make a decision. We did make a decision, and the decision was not to make a decision.
That is true.
That was overt on our part and deliberate.
We do that a lot.
But one of the things that you mentioned also is the belief that we are under considerable financial pressure when it comes to next year. And I haven't heard evidence of that even at this point. And as we go through this discussion, it might be useful to have someone in, whether it be our economists or whether it may be JFO, to give us some idea of what we're looking at as far as the next fiscal year. My understanding, I've heard the governor say as late as yesterday that we had something like a $300 million surplus currently. And I'm trying to reconcile that between our needs this year and where we're going to stand next year. And I think in making this decision, that's going to be important. Part of some people are saying, well, this stuff ought to be taxable because we have this revenue impact. But my understanding is that our economists haven't even taken that into account in the first place. And I would just like some clarity to all of this and some testimony to help us better understand it.
We are at this point, when they're crafting a budget, working on the revenue estimate that was done by the emergency board and all the economists and the governor in January. Normally, unless there's major changes, we will meet again in July to update that revenue forecast, generally for when they're doing the budget adjustment for next year. And then we do them in January and July normally. Graham has popped up, and I'm going to ask Graham. I know we have a lot of money now, but the base revenues and the base expenses continue, from everything I've been told, to do the crocodile jaw. They are about $30 million apart every year. And that's the last I heard, but it changes regularly. I think it's 3 years out when the federal money goes away. So yes, this is a one-time thing. It probably won't impact that, but we definitely will get that update before we make any decisions. Anybody else before I finally turn it over to Austin? Senator Sirotkin.
I just want to add to what Senator Brock and Senator Pearson said. My recollection also is that the message, and we could go back to the tape, but the message we got from the tax department is we needed to act on 2020. We could take some more time on 2021. I felt a hard push on the UI. I felt a hard push on the PPP for 20. I didn't feel from the administration a hard push yet on the PPP. So I think we're all saying the same thing. And I think there's a lot of misinformation out there.
Yeah, it gets complicated. We link up retrospectively, and that's never been a problem. We link to the federal tax code, but no one can ever remember the federal tax code changing in December. And so we were linked, the forms were out. There was a lot of pressure at that point when we first got back here, a lot of moving parts. And so that's, I think, kind of feeling a little squeezed and just wanting some time to look at things before making a decision about next year. So, Austin, it's yours.
Thank you, Madam Chair, and thank you, members of the committee. For the record, Austin Davis, Government Affairs Manager with the Lake Champlain Chamber. And I can certainly appreciate the complexities, difficulties, and stress of static conformity, especially at a time when Congress is creating legislation at a pace that we're not used to seeing ever. And as you were saying, when's the last time we've had static conformity that needed to be addressed from December? It is quite an interesting situation the last year has put us in, and I certainly miss the State House and miss having these important conversations in person with all of you. Thank you, again, for providing this opportunity to testify today on this issue of, severe importance. In addition to the written copy of my testimony, which I'll submit after I finish, I've also submitted for the record for your consideration, and it's on your website, quite possibly the largest coalitions of businesses and trade associations, as well as associations representing nonprofits and the medical sector, all imploring you folks to reverse the decision made in H315 and allow PPP loans to be treated as non-taxable grants. I know that what was said previously sounds interesting in the context of that. From our perspective, we're in a situation where if no action occurs, our members end up in a situation where they have a large tax liability. This list is incredibly long, so I won't read it. It's over 50 groups in its entirety, and it ranges from those who represent folks in the childcare sector, agriculture, business groups from all ends of the political spectrum, and many, many more. You can see that, as I said, in submitted testimony. I've also submitted for the record and for your consideration, correspondence dating May 5th, 2020, sent to the Trump administration's Treasury Secretary, Steven Mnuchin, in a bipartisan effort by the Senate Finance Committee Chairman Grassley, his ranking Democratic member, Senator Wyden, as well as the Democratic chair of the House Ways and Means Committee, Congressman Neal. The correspondence outlines the disconnect with the Trump administration's IRS 2020-32 notice. It presents research conducted by the Bipartisan Congressional Research Office, reaffirming that it was the explicit intent of Congress that PPP loans would be a tax-free grant if forgiven. And it underscores the intent and understanding of Congress that you might have seen expressed by Senator Leahy in the media, that this program does not function correctly unless the end product functions as a tax-free grant. Unfortunately, the Trump administration maintained that position, that that the forgiven PPP loans were taxable income, which then forced Congress to take the extraordinary step of reaffirming their original legislative intent in the Consolidated Appropriations Act in December, which was the next extensive coronavirus relief bill passed by Congress. You might remember that the GOP kind of held up negotiations through HEROES 2.0 and the HEALS Act. There were some smaller acts in between them, but nothing where they could address this. So due to the language in H315, the same threat to the proper function of this life-saving Paycheck Protection Program has reoccurred, as the Vermont legislation makes a forgiven loan a taxable grant under Vermont state statute. However, this creates a paradox, because if an individual were to withhold some of the funding from the loan to pay the new tax liability under that legislation, they would be actually ineligible for forgiveness, therefore preventing the loan from becoming a grant, which would render it untaxable. The taxable event created by H315 only occurs if the person has spent every penny of the loan according to the rules that must be followed to qualify for forgiveness. In contrast, a taxable event does not occur if a person does as 315 requests and retain some of the money for the newly created tax liability, which would then make it a loan and ineligible for forgiveness and maintain the loan as non-taxable. Of course, there's another scenario here in which the recipient receives only partial forgiveness, and that represents the worst of both scenarios. In short, it's a paradoxical tax designed to target people with no money, as only people with no money left or a less than desirable forgiveness situation are eligible to have their loan converted to a grant. It's a complicated heads I win, tails you lose situation, which is already mitigated at the federal level and then is recreated under H315 at a state level. Congress created this program with the intent of being a simple, non-problematic lifeline to those struggling from a global pandemic and the accompanying recessions. I've also submitted in my testimony for your consideration an infographic entitled, "Where Did Forgiven PPP Money Go?" which should clarify that the state has already collected tax revenue from the intended spending and downstream economic activity associated with the program. The program injects up to $1.02 billion directly into the pockets of Vermont employees who might otherwise have been put on unemployment. And by conservative estimate, this would likely have brought about $61 million in personal income tax revenue alone to Vermont state coffers. Additionally, those funds cycle through the Vermont economy to eventually reach state coffers in the form of sales and use, rooms and meals, and property taxes. In fact, the January 2021 consensus revenue forecast that was created factoring in PPP not being taxable envisions, and I quote, "personal income tax recipients' receipts are expected to reach record levels in the period of FY21 to FY23 and account for much of the above target revenue over this period," end quote. The state does not need to tax these forgiven loans for additional revenue, in part because these funds have already provided the state with additional revenue. Since then, the passage of the American Rescue Plan Act has also brought billions of additional money into the state. In addition, the infographic highlights how this tax is so unique, odd, and paradoxical. As you can see the flow of dollars is only through employers, with the employees being the primary recipient of the funds. The graphic also highlights how the program functions as a parallel unemployment insurance program. We all remember how strained our UI system has been over the last year, and without PP, the unemployment rates would have been much higher. More businesses would have closed the doors, perhaps permanently, and the economic fallout would have been more severe. As our state's unemployment system was strained and crashing, PPP created a parallel unemployment system to spread the load, with many employers simply using PPP funds to pay their employees to, quote, "stay home, stay safe." Additionally, there's a trauma associated with losing one's job, even with UI, and PPP kept that trauma from occurring by retaining employees on their original payroll with less uncertainty and no lost benefits and full wage replacement. I'm coming towards the end of this. I just have a few more points. First being that treating taxpayers differently for an arbitrary circumstance outside their control is just bad tax policy. While it may seem like a non-arbitrary line, there's little difference between those 2020 PPP recipients who so far have been granted forgiveness in tax year 2020 and those who have been granted or are awaiting forgiveness in tax year 2021. Many individuals lack control over when their PPP loan forgiveness occurs, as two applications for the same size loan might be applied for at the same time in 2020. And for some unknown reason, the forgiveness for one may have processed in 2020 and the other might still be pending right now. As we move forward, however, there are notable differences in the demographics that will be affected by this distinction, specifically those smaller employers who the program was revised to serve better under the Consolidated Appropriations Act, and sole proprietors, women and minority-owned businesses who were served well by the executive memorandum by President Biden under his new Treasury Secretary, which put a hold on applications other than those demographics. These revisions made the program better serve small businesses and the more vulnerable businesses, as evidenced by the average loan being only $53,000. Finally, I submit for the record for consideration a sheet of frequently asked questions, which corrects some misconceptions on the issues. And this also has my contact information for further inquiries. In conclusion, Congress created the PPP program in what might be one of the scariest and most uncertain times in many of our lives. Congress understood from an early date that the program would only properly function if the relief from these forgiven loans was treated as a tax-free grant, a position that was defended continually by the leadership of both parties as the Trump administration attempted to tax forgiven loans. If Vermont were to proceed with such a paradoxical tax, it would leave many already struggling employers in a complicated and compromised position due to an arbitrary distinction of what side of a particular day on the calendar a federal employee finally got to their application. Furthermore, Vermont did not establish this program, facilitate this program, and yet has benefited greatly from this program, along with billions in additional relief from the federal government, leaving additional taxation unnecessary. And furthermore, those who would most certainly need to pay such a tax are likely to include those who are most vulnerable and have received the least amount of help so far in the pandemic. The Lake Champlain Chamber, along with the other 50 plus organizations accompanying us on the letter we've submitted to you for your consideration, implore you to quickly reverse the language passed in H315. Please allow this federal program to perform unencumbered and as intended, and remove this unnecessary and additional stress from hardworking Vermonters. Thank you.
Okay, thank you. Any questions? All right. I'm going to move on to Thomas Lozon. Tom, the
Thank you. Volume okay?
volume's great.
Fantastic. Nice to see you, Senator. Nice to see all of you, maybe someday in person. So the concern, and we've been very careful, to couch, having listened to several of you at the very beginning, we've been very careful to let folks know that this is a discussion, not necessarily a policy change. What I'm hearing from business owners is they ask me, is it taxable or not? And I have to be honest with them and say, yes, under H315, it is in fact, taxable, but we're having these discussions. But so I just wanted to make sure that I mentioned that. And also, I wanted to thank you for your good work today. We're a year into this thing, and you're right, Senator Cummings. I've been practicing for 30 years now. And, we've never been changing the tax law at a federal level in December and then having to make those corrections. It certainly, it certainly has been a challenging year, but you've done some great work. From the outside looking in, I've watched the legislative branch work with the executive branch and get relief to our businesses. I certainly describe our economy as very fragile still, but, I'm proud of the fact that in Vermont, with your help, with the help of the legislature and the governor working together, we avoided, we were terrified a year ago at this time. We really didn't know what was going to happen to our hospitality industry, to our restaurant industry, to our daycares. And, for the most part, Vermont's really, because people work together, we've avoided that. And we've kept, our businesses are fragile, but I would describe them also as fragile but healthy. So this is the point in the program where we're going to watch paint dry a little bit. When we talk about the PPP program, the program that we're working with today is very different than the program that Congress passed back on March 27th of 20 under the CARES Act. And so I'm just going to take you through the different iterations, so to speak, of the PPP program so that you can understand if we choose to tax businesses in 2021, I want to make sure that you thoroughly understand who you're taxing and why. So the CARES Act was started, and you do have, I did submit this to Faith so that you do have a
Yeah,
copy
it
of it.
is on. It's up
Sure.
there. Yep.
Okay, so, under the CARES Act signed, as I said, March 27th, originally $350 billion of funding gone in 14 days. Blinked our eyes and it was gone. And it was clearly our largest businesses who had greatest access to those funds. Congress on April 24th decided to replenish the fund with $320 billion. But again, it was still mostly our largest businesses taking advantage of it. The Payroll Protection Program Flexibility Act of 20, that was really the big game changer for our businesses, for most businesses here in Vermont. Vermont, we tend to have smaller businesses, not larger businesses. And we do have some larger employees, but most of our businesses, 80% of them have under 50 employees. So that was a game changer for our smaller businesses because it extended the forgiveness period. The original CARES Act program gave a business, and the formula is still the same. Essentially, you get 10 weeks of payroll under PPP. That is the calculation. If you're under the second draw program, if you're a restaurant or hospitality business, you get a little bit more. But originally, they were giving you 10 weeks payroll and giving you 8 weeks to spend it. So 75% of the proceeds had to be spent in 8 weeks on payroll, and then the remaining 25%, there were fairly rigid program guidelines that they later changed. So under the Payroll Protection Program Flexibility Act of 20, which again happened in June, that's when the federal government said, we'll give you 24 weeks, not 8. We will reduce the payroll expenditure requirement to 60% instead of 75%. And they also corrected some other program deficiencies and gave businesses a little more flexibility in terms of how they could spend it. And like I said, this was the first game changer. This, as someone who has prepared literally hundreds of these applications, probably thousands, this was the first game changers, and it's where we really saw our smaller businesses start to step up because they were really concerned that they couldn't spend the payroll requirement in 8 weeks, and they were concerned they were going to be stuck with a big loan. And a lot of it too was everything, and you can certainly attest to this, everything happened so quickly. Everything was happening so fast. Between April 2nd, 2020 and June 25th, 2020, the SBA issued 25 separate interim final rule documents that we had to digest and read and then explain to our clients. So then we had S4116 that simply extended the program, didn't really make any changes. Got really interesting. I mean, as a practitioner, it got really interesting to watch. Usually Congress and Treasury work together, and it got really interesting to watch Treasury get angry or with Congress and vice versa. So the IRS in November of 20, they issue Revenue Ruling 2020-27, and basically this is where Congress got a little angry with Treasury because Congress was very careful under the CARES Act to say the proceeds of your PPP loan are not taxable. So Treasury got a little cute and they said, okay, we understand, we can read. So what we're going to do is we're going to say that the expenditures are not deductible. And Congress obviously wasn't amused. I spoke firsthand to Senator Leahy and Congressman Welch, and I can tell you neither of them were terribly amused, because the congressional intent was obviously to hold our businesses harmless, and they made that very clear, and Congress subsequently made that very clear. And then, so this was, again, it was about this time in October, November, when all of this was happening. We were getting data from the SBA, and I apologize, I should have mentioned at the beginning, I serve on the governor's economic recovery and mitigation task force. So I was on the technical side. We were the folks who were reading these 25 IFRs and digesting them and making sure we understood the rules. So it was right about this time, October, November, as the data was coming in and we were analyzing it as quickly as we received it. We really started to realize that we just weren't reaching our smallest businesses. We weren't reaching women-owned, minority-owned, the folks with 20 or less employees. They just weren't taking advantage of the program the way we felt that they could or should or would. And this was for a lot of reasons, a lot of misunderstanding of the rules and regulations of the programs. In my opinion, some of the banks had terrible lending platforms. Here in Vermont, we were fortunate. We had some great community banks, that Chris, works with often. And our community banks, I'll tell you, they were right there speaking to their customers, making sure their customers understood things. Other larger banks, very, multi-regional banks, just had a platform. They had a web page they would send the customer to, and they would expect the customer to self-populate the web page. And many of these smaller businesses simply didn't have time for that. So there were a lot of reasons why there were language barriers. We reacted in Vermont, very proud of how we reacted. We reached out to folks who could help us with translation and reach out to different ethnic groups and women's groups. But there were definite language barriers when you try to translate, an SBA IFR. It just doesn't translate well. So October, November, we start to recognize this, and they certainly recognized it at the national level. And what Congress came up with was the Consolidated Appropriations Act of 21. But remember, this was in December of 20. December 27th is actually when it was signed into law. And this was the real big game changer. Created the second draw program for our restaurants. Anybody with a NAICS code restaurant hospitality, if they took a second draw, if they took a second draw, they were allowed a 40% increase in that. It restated the application period, reduced the maximum loan amount. So they said, no, we're not doing these $10 million loans anymore. It reduced the loan amount significantly. Maximum loan amount became $2 million. Focused the initial lending period for a period of weeks on underserved businesses, women and minority-owned businesses, as well as underserved businesses in certain neighborhoods. So that was really the big, game changer. And then finally, the last game changer for our smallest businesses was just the SBA recognizing that sole proprietors were at a huge disadvantage. They were making sole proprietors use their bottom line. So if a sole proprietor, for example, their PPP loan was being reduced because of things like depreciation expense. And for larger corporations, they were going purely on a payroll calculation, didn't have to take that into account. So the SBA changed that. That was quite a ways. We were quite a ways into 21. That was actually on March 3rd that they did that. And then most recently, we had the PPP Extension Act of 21, which President Biden signed on March 26th of 21, and that extended our current program until June. So we've seen a lot of changes in this program. So what I'd like to talk to you about now, very quickly, is who benefited. So as we saw these changes, who was benefiting? And so I'm on page 3 now. So clearly under the CARES Act, I can tell you it was the largest initially. It was our largest businesses who benefited. They had no concerns about the 8-week expenditure and forgiveness period. They had no concerns about the 75% requirement for payroll. And, $350 billion was gone in 14 days. We did very well here in Vermont, but it was clearly our largest businesses who benefited from the CARES Act. And then when the program was reappropriated on April 24th, the PPP and Healthcare Enhancement Act, when we reappropriated additional funds, again, it was those larger businesses. We had a big backlog from the CARES Act funds of $350 billion that literally was gone in 14 days. We had a bit of a backlog. So for the first few weeks, really our lenders were catching up on that backlog. After about May 31st, probably the end of May, we could see that we were reaching businesses with 50 and over employees as those businesses kind of became more educated, more comfortable with the program. But, prior to May, it was our largest employers and businesses who were getting the most benefit. And then so along in June, when we saw the PPP Flexibility Act and we switched from that 8-week period to 24-week period, that was huge. All of a sudden, we started seeing our businesses. It was sort of this shift nationally where they started listening to practitioners and recognizing that small businesses weren't taking advantage of this program. So when they shifted from 8 weeks to 24 weeks, that was a real game changer. But keep in mind, that was June. So put 24 weeks out of your mind and just let's talk half a year, because it's easier to do the math. So June is when we really started seeing more of our businesses apply. And so let's assume that pursuant to that, that June change under the PPP Flexibility Act, you get a lot more businesses in Vermont start applying. And they've got a 24-week forgiveness period, but we're calling it half a year. Well, if they apply, towards the end of June, the act is passed on the 5th of June, they get their application in by the end of June, the soonest they can put their forgiveness application in is December. So, right away, we're seeing those businesses sort of at a disadvantage. The largest businesses got served in early 20, and I can tell you they got forgiven in 20. They're not going to be affected by H315. But our smaller businesses who started jumping in the pool in June because of these necessary changes to the program, they're going to see their forgiveness. A lot of them saw their forgiveness push forward to 2021, and they're definitely going to be affected by H315. And one of the biggest things we saw, and I can't even explain why, no one can. And as I said, we submitted many forgiveness and PPP applications. We would prepare 2 virtually identical applications for forgiveness, prepared for the most part the same way. We would submit them within days of each other. One application would be approved in 2 weeks and one would take 9, with the SBA asking us for no more information. So we can't even tell you why business A, in my example, was lucky enough they're not going to be affected by H315, but unfortunately business B, through no fault of their own, having submitted an identical application, they're going to get taxed in 21. And we saw a lot of that. Moving to page 4, I'm going to go through this really quickly because I'm sure you're being generous, Senator, but I'm sure I'm starting to run out of time.
This has actually been helpful.
Well, good. I'm glad, because that's why we're here. But looking at the numbers, you can see the utilization. So 416. Go to the middle of the page where the line before it says the preceding data is cumulative. What happens if we isolate the data? We actually have to make this. I have to make this. The SBA doesn't present it to us this way. So we've always got to be constantly drilling down into the data. And one of the things the governor had asked us to do is always be looking to protect our smallest businesses, our women-owned, minority-owned, make sure they're utilizing these programs. And so clearly under CARES, they just weren't. Our largest, the big dogs ate. There's really no other way to say it. The businesses with the most resources, financial and human resources, they clearly benefited most under the CARES Act. So our largest businesses got the money in early 2020, were forgiven in 2020, and H315 won't affect them. But as we move down, if you look at 416, then 530, 630, and 88, you can see how the average loan size is getting much smaller because we're reaching our smaller businesses. We started to reach the women-owned, the minority-owned, because they no longer were afraid of the program because we moved away from that 8-week forgiveness period and said, hey, we'll give you 24 weeks. And I can tell you that was the game changer. They became very comfortable with the thought, we're not going to get stuck with a loan. This is going to be a program that we can use to supplement our payroll. Restaurants utilized it a lot, where restaurants are operating at 50%, but they wanted to bring their entire staff back because there were certain days of the week where they jumped from 50% to 100%, and even the restaurants couldn't explain why. But they had to be fully staffed. So the PPP funds, those were essential during the summer months as our restaurants, moved to outdoor dining and we're trying to recover. And then lastly, we expected, you can see the average loan size under the Consolidated Appropriations Act. Keep in mind, you're looking at round 2 and round 1. That's the way the SBA gives us the data. So you can see how, the utilization jumped up a little bit. That was expected because of that 40% bump. Second draw loans, if you're a restaurant or hotel, you get a 40% bump in your PPP loan. So to make the math easy for you, if you got $100,000 in round 1, you would get $140,000 in round 2. So, in conclusion, as we look at this data and look at who H315 in its current configuration would affect most, I'm very confident saying to you and testifying that H315 as enacted would absolutely affect our smallest, most disadvantaged and hardest hit businesses the most. It wouldn't affect the larger businesses who received their PPP funds early in 2020, were forgiven in 2020, and then didn't qualify. I would say about 50% of our businesses did, but about half of our businesses who got a first draw didn't qualify for the second draw because you had to have that 25% revenue reduction. And so businesses that had sort of weathered 2020 fairly well just didn't qualify. They just didn't hit that 25% revenue reduction. So, and obviously, if you're applying under a second draw, that act was only signed by the president on December 27th. There's no possible way you could have gotten in for a second draw and had it not be in 2021. So those folks are, and that's the concern that I'm hearing from the business community is they're looking at me and they're saying, but Tom, it's the end of April. Not all businesses take 24 weeks to spend the payroll funds. And they're looking at me saying, the money's gone. We spent it in accordance with the program requirements. And now if it is potentially taxable, and we're talking about their first draw and second draw PPP loans. So, even with our smaller businesses, we're talking about, potentially $20,000 or so in income taxes on money that they don't have. They spent it within the program requirements, and so those funds are gone. So with that, I will wrap it up. I thank you for being so generous with your time. Once again, be happy to answer any questions.
Thank you. Any questions at this point?
I have a
All right,
question.
Senator Sorokin.
Thank you, Tom. Good to see you. So what is, just as a general rule of thumb, what are we talking about in terms of tax rates here? Is it the 3% to the 9% range?
Yeah, depending on it's the rates are graduated, but you nailed it. You know it as well as I do, 3 to 9%. Depending on where your level of income is.
Okay. And do you have any sense of, I know we need to get this from JFO, but how much forgiveness is at stake here, whether it's tax, what the guesstimate of what the amount of money in terms of forgiveness is at stake here in the state of Vermont? I mean, if you took the 3 to 9%, just say arbitrarily, say 6%, 6% of what number? How much loan? How much
Well,
PPP
we've
loans?
under the Consolidated Appropriations Act, Senator, we've loaned $534 million.
Oh, that's right. I
Under
heard
that, and that was all in 21.
Okay, and then there was another like 1.5 that was loaned in 20, but some of that may have already been forgiven.
Yeah, and I think getting that math out of the SBA for Vermont would be difficult. You know, I could take a guess. I would be surprised if the number at stake didn't approach. You know, we loaned over $1 billion in 2020 under the first few acts.
Right.
So if we just say, okay, let's say $300,000 to $400,000 of that 1.2 billion, 3 to 400 million. I live in Vermont. I'm not even used to talking in numbers this big, and I still struggle with it. So, you know, the number could be as high, Senator, as $750 million. And I got that just by adding 250 million to the 534, because obviously, you know, funds for which folks would be seeking forgiveness towards the end, you know, November, December, they just didn't get forgiveness in time. So they'll spill over, you know, they'll spill over into 21. I hope that helps.
Well, it does, except it's a far cry from, if you took 750 million and you took, let's say, 5%, that's
37 million dollars.
Yeah. I thought what we had heard from joint fiscal for both 20 and 21 was 6 million. In terms of
I'd have to see I don't understand their math. I don't understand how it could be that low, but
Yeah.
I'm certainly not going to question joint fiscal. I'd have to see their math.
Well, we'll hear from them, I'm sure. Okay.
Okay,
Thank
we
you.
will have joint. Graham, do you have a short answer for us? I see you lit up.
Graham from the Joint Fiscal Office. I can weigh in later, but our guess is that it's somewhere around between 300 and 400 million that'll end up being taxable. And a big reason for that is we had to make assumptions on whether a corporation or a pass-through who received a PPP loan will even be profitable once the PPP loan, even if it is made taxable. So you might have a situation where a business is still in the red or reporting zero taxable income, even once they are, or even once you count PPP forgiven loans as taxable. So that's the first. And the second is we had to sort of take a guess at whether businesses who would otherwise potentially be profitable would be potentially essentially shifting payroll expense into another form of deductible expense. So this is the business that took a PPP loan, used it to pay payroll, and then took their money that they had available potentially for payroll to, you know, make an investment because their business was expanding down the road, like buying a truck, in which case that drives down their taxable income. So we had to make some assumptions around those. So it wasn't just a simple, straightforward, you know, take the SBA data and then multiply it by certain tax rates because there are a lot of factors at play here.
Okay.
Can I ask one follow-up question? Because of what Graham just said, I've always been a little confused on the PPP program about this. Our first witness said that this was a backfill for the unemployment fund. Is it possible to get a PPP loan and use it towards payroll that you would otherwise be keeping people on anyhow? Tom, do you know the answer to that?
Well, it's payroll in general. There's no distinction. There's no distinction between the two, Senator. To qualify under the, you know, payroll is payroll. What we did see, what I saw as a practitioner, working with small businesses, is some of our small businesses, when they got their PPP loans, they absolutely kept people on payroll that they would have if the choice was no PPP or PPP, they took the PPP loans and they kept those employees on payroll because they were comfortable that they had the funds. So there's certainly, in my opinion, I think there would have been significantly more layoffs in 2020 had we not had the $1 billion in PPP funds, 60% of which went directly to supplement payroll.
I guess my question is, not every business got hurt by the pandemic. Some did very well and their business increased. Could they get a PPP loan?
They could absolutely get a first draw in 2020. They would not be, as you said, if their business increased, they'd have to show a 25% decrease to get a second draw in 2021. And it's the second draw folks, the folks who got hurt the most, who are more likely to be taxed.
Okay, thank you.
Thank you.
I'm going to have to move us along because we're running out of time. So any final questions for Mr. Lozon? Okay, I'm going to move on to Karen Bradley. And there.
Hi, can you hear me okay?
Hi. Yes, hear you fine.
Okay. And I'll be 5 minutes at the very max, but thank you very much for taking the time to hear testimony today. And from me, I am here as a local business owner. I am a veterinarian and I own Onion River Animal Hospital in Berlin. And I know Anne.
Say for full disclosure, she
yes,
is my daughter's employer.
Yes, I wanted to say that. And so actually her daughter could give you firsthand. I wanted to give you a little bit of the personal part. Austin mentioned trauma, and March and April and May last year were extremely traumatic as a business owner. My employees saw me in tears, sending them home, reduction in force in March and April, because everyone in Vermont that are my clients did what our governor said. They stayed home. I have fixed costs. I have a certain amount of money, and it goes up every year that we have to bring in revenue every day to pay the bills, to keep the lights on. So that's not just payroll, everything else. Those fixed costs did not go away, but my income was gone. And when we weren't allowed to provide services, we weren't allowed to do routine things that animals need. We were supposed to only do sick and urgent. Again, we were, just like Tom mentioned, we applied as fast as possible for the first round of PPP. Literally the trauma each night of watching the news, checking my email to see, did I get approved? Did I get approved? Nope, the money was gone. And I was in a horrible place. And I know a lot of business owners too. What am I going to do? What am I going to do? When the second round came, our application was already there and we were doing everything we could. And we were so fortunate to get it. And as soon as I got notification that I was getting the money, every one of my employees came back full time. Every one of them, even if I didn't have work for them, they were back. And I even used some of the funds to pay the ones that didn't file for unemployment for the amount of hours they were reduced. I paid them, everybody I could. I paid them that I could document it. I paid them whatever wages that I had not been able to give them in March and April because I was so grateful. Fortunately, things went well as far as our business and we've managed to maintain. But when we did the formula for how to apply, you could take, your payroll, 8 weeks, a little bit of like rent, utilities, and those things. Nowhere did they say, oh, and in case your state wants to tax this money, factor that in too. So there's none of this money left. I did apply to get forgiven. My forgiveness is in 2021. The funds were received in May of 2020. They were used by I took 8 weeks. Boom, all that money was gone. So it's gone. It went to your employees. They didn't have to collect unemployment from our state anymore. And they only collected a tiny bit. Like most of them, if they were reduced by 25%. So I did what the program said. And to me, holding up what the federal government is doing is the right thing to do. because it is completely arbitrary, unfair treatment for when your loan actually gets forgiven. That if I managed to squeak it out in 2020, I would be, and for me, it's probably, I think I'm someone that it's like I have to come up with $20,000 or $30,000 if I have to be taxed on this to the state that I do not have. So I guess that's my big thing. And my biggest thing was that I really felt terrible that I had my employees take any unemployment, like that they did that, and frankly, you probably all know this too, during that period of time, when I said, come on back to full time, many of them said, can I just stay like I am? Because I'm getting an extra $600 a week from the federal government. So I had to compete with that. It was better to come back to work than to stick with getting that extra unemployment. So you really, it is the small, it is, I have 30 employees. I'm healthcare. You know, if animals aren't healthy, neither are the people. And we were essential, but not essential enough to be able to be fully open and provide all the services we needed to pay the bills. So thank you very much for your time. And I can answer any questions if anyone has any for me.
Okay. Any questions? Sandra Hardy.
Thank you, Madam Chair. And thank you, Dr. Bradley, I'm assuming.
Yes. Thank you.
Thank you for your personal testimony about your individual business. And thank you for being the very first witness of our 3 witnesses who didn't already presume that a decision had been made. So I appreciate that you came to us and tried to make an argument for why we should make a decision one way or another and not make the assumption that we'd already made a decision like our previous 2 witnesses had. So I appreciate hearing from you and your personal story. And thanks for your hard work over the past year to save your business and take care of your employees and everybody's animals.
Thank you. And I love to say, so the Vermont Veterinary Medical Association, there were a lot of veterinary clinics in our state who, I don't have the statistic, but that did get PPP funds to stay afloat because they just needed it. So I would say most veterinary practices in the state did.
Yeah, I've heard from several of them. So the organization is out in force. So, but thanks for your testimony.
Thank you.
Okay, any other questions? All right, if not, I'm going to go on to Leo O'Reilly. Leo, there you are.
Hi there.
Hi. People jump around on these screens.
I know. It's kind of hard to keep track when there's so many. Well, thank you, for your time today, and thank you, Madam Chair, and all the senators, and especially thank you, Dr. Bradley, for your testimony. I think that really starts to hit the point that, we see. My name is Leo O'Reilly. I'm an accountant in South Burlington. I work primarily with clients in the restaurant and hospitality sector. Part of the Vermont Independent Restaurant Coalition, which is what has brought me here today. And I'll keep my, thoughts somewhat brief. I just wanted to, reemphasize some of the things that we've already heard. So there's no, I don't feel there's a need to, kind of go into, a significant amount of comments. So I just wrote down a few things to kind of touch on and reemphasize as you consider this decision on whether to tax the PPP for 2021. So the first thing was that, Congress has, had debated and finalized this issue. I know it was late in the game and that the rules had changed several times over the course of the last year. And certainly, as people like Tom and I can attest, it made our lives, very complicated as we continued to try to explain and re-explain, what was happening with the program and how to best take advantage of it. But as we did that, as Karen had said, we never anticipated the taxability. We felt confident that Congress was going to clarify that issue because that was their intent. They eventually did clarify that issue. And then we felt that, Vermont and based upon the communication that we were getting from the tax department, that the state of Vermont would conform to that for loans forgiven in 2020, as well as loans forgiven in 2021. So we've counseled our clients based upon that, that they would, have the ability to spend this money without having to pay taxes at the end of the day. I think the most important thing that has come out of this conversation today, is that the majority of the loans that we're talking about here are going to be the ones that were originated in 2021. There are going to be some residual forgiveness that, from 2020 that got forgiven in 2021 that could potentially then become taxable. And I just can't emphasize enough, who those businesses are. I know that Tom did a very good job of, articulating that. And I just want to reinforce that these were businesses to qualify for that 2021. You had to have been, to show that your business declined by 25%. It was focused on, women and minority-owned businesses. It was focused on small businesses, and it really would be challenging for those to be the businesses that are now taxed, especially because what has been communicated, and which hopefully is understood, is that there's no money within the PPP itself to pay those taxes. That it's for payroll, rent, certain other operating expenses and what have you, so that the money to pay any additional tax would have to come from other sources. And I think that would be a significant burden, especially as we look at over our client base, which has had a terrible time. There's no, restaurants have suffered deeply, and so kind of follow on that. The thing that I would want to also emphasize is that we see that their economic turmoil will continue into 2022. That it's not something. So they're going to spend the money this year as it's been prescribed, but their businesses are not going to recover. So one potential that I see happening is that because of the PPP funds that they've gotten and the Vermont grants, that they could have taxable income for 2021. Including the PPP, and that they are not going to fully economically recover in 2021. It's going to take through 2022, and to have a tax burden that hits them, in the beginning of 2022, while they're still trying to economically recover on money that they already spent in the beginning of 2021, I think is going to create an additional burden. That I see that we're still a couple of years out from a full recovery. Feeling hopeful, people are getting vaccinated. The summer hopefully will be good. Restaurants will hopefully be open, but as we project out, revenues for 2021 summer for these restaurants, we're seeing, okay performance, better than 2020, but not anywhere near what they would have experienced in 2019. And that we're not going to start to see that kind of back to normal sales until, at least 2023. It's going to take another year. And so again, to put an additional burden of taxes while they're trying to hold together their business, seems like not a great use, of their funds. And then the last comment that I had was that we fully anticipated, again, I think I had already said this, that we were getting counsel from the tax department that even though this situation had not been fully adjudicated, that they anticipated the conforming, and we counseled clients to spend the money from the second PPP, as without making any reserve, for the money to be taxable. So it's all. I think I'll leave it there. I think I'm just reinforcing some of the points that others have made, and hopefully that will help clarify the situation for you.
Okay, thank you. Not seeing any questions, so I'm going to move on. Senator McDonald, short questions. You're muted, Senator. You're muted, Senator.
when the federal government changed the rules last December, I'm going to back up further, Madam Chair. Last summer and last fall, I was impressed with this state and the people who worked hard to move the relief funds along, and they did it together. And it was an amicable activity amongst people of good faith. We were fortunate enough to get a much larger slug of money than any other state did, and we did it together. This spring, the Commissioner of Taxes came in and shared with us the changes that the federal government had made retroactively. And he had 5 areas, I think, where things had been done after the fact. And this committee fixed 4 of them immediately at the request of the administration. And it took the 5th one and it said, we're going to put off this decision for a little while until we understand it more fully.
Senator,
That's
I
what
need a
happened.
question because we're running out of time.
Then I'm going to ask Madam Chair, why the witnesses who now know that we had not made a decision on this are coming and making lengthy presentations on this issue. We are behind in our work here in the legislature, which is one of the reasons we put this off until we had more information. And we're not dealing with the work we have to do to get through the next several slugs of money. And it's a more difficult task this year because the various parties have gone back and looked at what happened last year and said, my goodness, if we'd advocated more for our position, if we less work
Senator,
together.
I'm going to take this as an editorial comment and ask you to put it off until we're into discussion. We invited these witnesses to give us the information that we said we needed to make the decision. Okay? But
Thank you, Madam
All right.
Chair. And I will sit here and wait to hear the same thing over and over again from.
You are free to shut it off, Senator. Okay, I am going to go on to, if any questions for Mr. O'Reilly. Okay, I'm not seeing any. I'm going to go on to Chris D'Elia.
Thank you, Madam Chair. Good afternoon. Good afternoon, committee members. For the record, Chris D'Elia, President of the Vermont Bankers Association. I know you've heard quite a bit already, and I'd like to leave additional time for the remaining businesses, so I will try and be brief. I think, correct me if I'm wrong, but a decision was made in H3 15, but we're under the premise that there would be further discussion. So absent any additional action from the legislature, I think the decision's already been made under 315. So I just put that on the table. The PPP program is one that has been filled with complexity and changes over time. If we were to look at the Treasury's webpage, there are 109 hyperlinks that take you to various documents dealing with applications, frequently asked questions, independent or interim final rules that everybody has had to try and work through over the last year. Quickly, the numbers: April 2020 through April 2021, 20,548 loans have been made here in Vermont. In 2021, 8,146 loans have been made. When you look at the total numbers for the program, $1.734 billion has been made in Vermont. And just in 2021, $534 million. National data shows that 93% of the loans are under 150,000 and the average loan size is 51,000. And just so we're clear, that's lenders' capital that has been made available in the marketplace. What the federal dollars appear when the loans are forgiven by the SBA, and we get that information from the SBA. It's already been said, all types of businesses have applied for the program as long as they felt they could meet the guidelines. There are many businesses early on that just dismissed the program because they felt they couldn't qualify, or perhaps they didn't have the financial technical expertise to put the documentation together that was needed in order to apply for the program. And yes, we've heard stories about businesses that perhaps received funding that they shouldn't have. Certainly those stories were in other parts of the country. And as a result, Congress made changes to the program that tightened the guidelines. SBA now has a higher level of loan review once they're submitted and a higher level of review for loan forgiveness. And those changes were made in 2020. But focusing on 2021, the target audience as a result of congressional action late in 2020 was to focus on sole proprietors, women-owned businesses, minority-owned businesses, and independent contractors. In fact, the SBA set up a dedicated 2-week period in February in which businesses who had 20 or fewer employees were the only ones applying to the program. So here we are today talking about tax treatment, and I want to be clear that we do not question at all whether you have the right to set tax policy or not in the state of Vermont, but we would ask you not to tax these loans. There is no doubt that Congress meant the PP loans to be exempt. That was clear in the CARES Act early on when it was developed. And it was restated several times either by Congress or Treasury in the guidance as the program developed over time. And why is that the case? Because this country has seen an economic crisis unlike any before. They recognize the difficulty the business community has been going through. And I personally, as I talk to my commercial lenders who don't go into details, but they share anecdotal stories, I can't imagine where the citizens and businesses of our state would be without this program. I think we'd have far fewer businesses with us today. So these are businesses that have been operating with little to no income coming in over time while adhering to the state emergency guidelines, appropriate guidelines, I should add. And those guidelines are still in place. The PPP loans were designed to keep people employed. That was the fundamental purpose of the program. And that was because I don't think there's any way the country or even Vermont through the unemployment system could have handled so many people out of work. So this is how the program was designed by Congress. Yes, the funds were used for other purposes, mortgage payments, utility expenses, and so on. And at the end of the day, the bargain was, at least from the federal government, if you spent the proceeds appropriately, the loan would be forgiven and would be tax exempt. In fact, we're one of the organizations working with our congressional delegation that asked for automatic forgiveness for loans under $150,000. It made sense because those were the businesses that were struggling the most. There is an application process that businesses have to go through. It's one that has had its challenges. It's unfortunately been slow because you can imagine the high volume of applications coming in from across the country. Even though there was a statutory 90-day time frame that SBA had to meet, there are certainly cases where they have not met that deadline. And that's due in part to a high level of scrutiny, staffing issues, technical issues with the websites and the portals that have been used. So people are correct. You can absolutely have a business who applied for PPP forgiveness in 2020 and they've yet to receive it. But those businesses in 2020 did everything they were supposed to do by keeping their employees on the payroll. So we would ask for the same treatment for those businesses who are still struggling, still keeping employees on the payroll, still adhering to the emergency guidelines in 2021. Please don't treat them differently. If you were to talk again to my commercial lenders, you'd hear many stories about businesses that are still hurting out there because the economic crisis is far from over in Vermont. Even though there's absolutely light at the end of the tunnel, through the reopening that's been announced under the administration, restaurants, lodges, retail venues, and others are still waiting for the summer and fall activity to unfold to hope to get back to some level of normalcy. But as Leo alluded to, again, looking at 22 or 23 before we get back to a pre-pandemic timeframe. So at the end of the day, senators, I greatly appreciate your willingness to have this conversation. We would ask you not to tax the PPP loans in 2021, and I'm happy to answer any questions you may have.
Okay, any questions at this point? Okay, not seeing any. I'm going to go on to Bram Kleppner. Bram, welcome back.
Thank you, Madam Chair. Thank you, members of the committee, for your work on this and for your time today. My name is Bram Kleppner. I'm CEO of Danforth Pewter in Middlebury. And just a couple of quick issues that I'd like to put before you. I guess the request that you are hearing is that we reverse the part of H3 315 that made the PPP taxable. The governor let the bill become law without his signature, and I understand it was over this specific issue that he chose not to sign that bill. So, one issue that we haven't talked about today, but that I have heard concern raised, in the previous administration in Washington and also here locally, is that somehow there's double dipping going on if you don't tax the PPP funds. And from our point of view, the regime that exists in law and in policy of deductible expenses for business is long established and stable. You sell stuff, you get money, you spend some of it on expenses which are tax deductible, and you pay taxes on the rest. And when money comes through the PPP program, you follow the same regime. You get the money in, you spend it on this and that. Some of the expenses are deductible, and the rest is not deductible. If it's non-eligible, you have to pay it back. It's a loan that has to be repaid, and if they are eligible expenses, you can get those forgiven. So there's only that single gift, as it were, that single dip is the forgiveness of the loan. The rest of it is sort of standard practice. And so, I think people get caught up in the fairness and double dip issue, which I think if you drill down is really not a legitimate concern. And I'd also just expand very briefly on sort of the tax paradox that Austin brought up. Business doesn't have enough money to keep all its employees on, and possibly not even enough money to survive when the pandemic hits. Applies for a PPP loan and gets it. If you spend it all on eligible expenses, payroll plus the small percent you're allowed to spend on rent and utilities, it's all gone to that. If you then pay taxes on it, you're paying those taxes out of the insufficient amount of money that you had to begin with. If you get a $100,000 PPP loan and you set aside 6%, say, to pay taxes, you spend the other $94,000 on eligible expenses, which gets forgiven. That $6,000 that you set aside to pay for taxes doesn't get forgiven, so it's a loan that you have to pay back. So that $6,000 has to get paid back to the feds. And again, you're paying the taxes out of that insufficient amount of money that you had to keep your people employed and your business afloat. So, either way, if one taxes the PPP, it gets taken out of the company's original cash flow, which was not enough to keep people employed. I will, by way of full disclosure, say that Danforth Pewter received a first round Paycheck Protection loan, which was forgiven in 2020. And we received a second round Paycheck Protection loan, which we are hoping will be forgiven in 2021. So, we sort of have a personal interest in the outcome of this, as well as a broader community interest.
Thank you.
Okay, Graham, I'm going to have to ask you to wrap up because our next witnesses are here and we have a hard stop at 3:30. And
well, that's perfect because I was done. So
okay.
Thank you all for your time and your work and your consideration.
Unless there's an absolutely essential question that hasn't been asked before, I'm going to move on to Matt Musgrave. And for the folks that are here for the banking and insurance bill, I'm thinking we're going to be, it is now a minute late, probably another 10 to 15 minutes. Because we've got that, and then we've got the transportation bill that they want our comments on by tomorrow, or was it today, for the electric vehicle rates. So I'm going to move on to Matt, and Matt, the floor is yours.
Well, thanks for having me, Madam Chair and committee. And for the record, my name is Matt Musgrave. I'm with the Associated General Contractors of Vermont. First, I want to apologize for the situation that we all live in. This is absolutely the worst way that I've ever seen legislation take place. And I can't wait until we're back in the building and we can look each other in the eye and share a lunch with each other. This has been very, very difficult as an advocate to deal with. And I'm going to be quick. I'm speaking in my YouTube ×2 voice right now. So I'm going to go very quickly. I don't believe that you've made a decision on this yet. I'm not saying that. I believe that your decision will likely be to not tax these grants, whether it be by the end of this session or whether it be next session. I can tell you that this program helped prevent unemployment trust fund bankruptcy, kept people at work, kept people buying houses, kept people healthy. When they're stuck in their house, that's not healthy. So we were able to get people back out to work. And I'm urging the Senate, and I'll urge the House, to find a vehicle to put the exemption to the taxation of PPP for the 2021 loans in as soon as possible. And the reason why I'm suggesting this is so that businesses have something that they can depend on, so that they can project what's going to happen in the future, so that they know when another paycheck protection loan comes, if we have another outbreak of the pandemic and people have to go home, that they can make the decision to take that loan and pay it to the people so that they can continue with their lives. Without that reassurance that they're not going to be taxed, they may consider not to take those loans and let those people go on to unemployment. That's what I have for today. I urge you to find some sort of a vehicle to put that language in this year. Thank you.
Okay, thank you, Matt. And rest assured, the chair has a vehicle. I always have a Christmas tree to decorate.
Thank you.
Okay, any questions? If not, I'm going to move on to Mark Sherman. Mark, there you are. You were here.
So, Madam Chair, thank you so much, and all the senators who are listening, including my neighbor, Michael Sirotkin. Really appreciate the opportunity to testify here and influence the decision that you are going to make, hopefully in the right direction. I want to reiterate what everyone else has said. Sorry, Senator McDonald, that we really appreciate the PPP loans and the grants that the state provided, and what they allowed us to do is to bring back our full employment far before we would have been able to otherwise. What it allowed us to do as an employer of 150 Vermonters here in Burlington, Vermont, is, for those who don't know, I'm from the Outdoor Gear Exchange, one of the owners. What it allowed us to do is to not begin to make nickel and dime decisions as to who we could and couldn't bring back. In 2020, we saw a $3.4 million shortfall in our projected sales. Yet, once we were open on May 18th, within a month, we were able to bring our staff fully back. And we were able to keep them in place despite several months of ongoing shortages in sales, as we considered lots of measures to make sure we kept our community and our customers safe. I want to state that by having a screener at the door until about 3 weeks ago, making sure that all travel advisories were being maintained by our customers, and by employing additional people to maintain the Department of Health standards for cleaning the building, we have a record of having had only one case of COVID in our 150 employees in over a year. And I'm very proud of that, because my employees, who are all in their 20s and 30s and active socialites, stayed home, took care, and made sure that they took care of our community. And the loans and the grants that were provided and forgiven by the federal government and the SBA were absolutely critical, because we saw that loss of sales in 2020. We continue to see shortcomings against what we projected for 2021. We've reprojected, so we're actually meeting those projections, but what we had expected was growth off of a year that we expected growth off of, and we're not seeing that. To Tom's point, we made decisions around adding people, or not choosing not to bring people back, because we had these funds and we knew that we were going to be able to spend them and get them forgiven, and we made our decisions around that, and in doing so kept our entire staff employed. More importantly, in a time when we've got lots of diversity, equity, and inclusion issues, we've been able to make sure that we focus on those, that we've been able to make efforts to increase the diversity in a non-diverse state, in a non-diverse industry that we work in, to work on issues around inclusion for our female staff who are looking to grow their careers. And we've been on a mission to raise our minimum, our base starting wage to $15 an hour for the past 3 years. And these funds allowed us to continue in that direction so that when the state ultimately chooses to raise the minimum wage, we will be in that position. We won't have to let anyone go at that point. So all of the decisions that we've been making as a result of these loans and the grants that the state provided have allowed us to grow our business in a time when, or to grow our investment in our staff in a time when our business isn't growing, and to redirect those efforts towards the parts of the business that we see growing, and to gird ourselves against a potential shutdown that may happen again. We've always had that in mind. We've always known that while the direction the state is going is so much better than the rest of the country, there are things we don't know going forward. And that's something this year has taught us, is that we can't assume everything is business as usual and is going to continue on the same trend that we've seen. And these funds have been critical. I would urge the Senate and this committee not to include this taxation. The federal government deemed it not taxable because they saw this as a necessary funding and cash flow effort to maintain small businesses. And yes, some businesses have benefited from this pandemic and have benefited from some failures in the way the PPP loan was rolled out, but it was rolled out to make a gain, and the overall economic impact has been positive, and Vermont has stood ahead of the crowd. And I would like to see us continuing to do that. And I would say, based on the numbers presented, if it's between 400 and 750 million in forgiveness, and we establish the tax rate to Vermont is 3 to 9%, we're talking about a $12 to $67 million tax hole that needs to be made up somewhere. And it seems as though there's a lot of federal funds available that we could think about how to do that with and to consider. But we'll be seeing the shortages in sales over the course of the next 2 years, because not only are customers going to be reticent to travel and to come to Vermont, where a lot of our business comes from, people have shifted their business to online, which means we are losing business to Amazon and other sellers of our product around the country. And we have supply chain issues. So in parts of our business are down by 50 and 60% because people don't browse for clothing if they're not allowed in the store or if they're not allowed in the state. People do buy paddling gear, people do buy biking gear and camping gear, which have been boon markets for everyone, including ski gear, but we can't buy products. So we're losing sales every week because we can't fill our customers' needs. And we're not letting people go when that happens. In fact, we're figuring out ways to bolster our employment through all of this. So without dragging on, I know there's time limits. I'm certainly open to questions, but I just wanted to bring up some of those losses and how we use those funds and express my appreciation for the work that you're doing to try to make sure these funds aren't taxed, hopefully.
Just say thank you. We don't have time for questions because I'm losing my lawyers in 5 minutes. They also have very tight schedules. So thank you. Thank all the businesses. I have a small business that's been bleeding for a year too. So I understand. Fortunately, I don't have employees, so I don't have to worry about that. Thank everyone in committee. We're going to move on. This is S88 that has come back to us. It's the insurance housekeeping, but I understand it has come back to us not just with healthcare, but the health insurance separating the markets, but with another. And I was happy to see that Jill Rickard has joined us. And Jen, Maria, I'll let you battle it out. Who's on the tightest time? But if someone could tell us what's in this bill, because I believe it'll be up on the floor tomorrow, and we're going to have to make a recommendation to the Senate. So,
Jen, it sounds like you might have a commitment after this. Do you want to start with your sections, or?
I don't want to be confusing. I mean, I'm going to meet with some folks after this, but I can be a bit flexible. So if it makes sense to just kind of go in more in order, we can do that.
Okay. I don't think this is going to take too long. So maybe we will just work our way through.
There aren't too many provisions. So this is the House proposal of amendment, there's one kind of non-health provision that was added that has to do with deferred annuities. And that's
Yes,
in
and that's why I'm glad
section-
Jill's here.
Yes. Section 33, and I can actually pull that up if that's helpful. Would you like me to share screen?
Yes.
Okay. Okay. Let's see. Let me.
Section 30. I'm on 3.
Make this a little bit bigger for you. Okay, so I'm actually going to scroll down to, I think it's page 48. We're not actually going in chronological order right now. I think my section might go pretty quickly. It's confusing, but I think it's pretty straightforward. So again, this is in section 33, which is at the top of the page that's visible now. And this is an amendment to Vermont's existing, it's called the Standard Non-Forfeiture Law for Individual Deferred Annuities. And essentially what it does, if a person contracts for an annuity, it's in the accumulation phase, that is, they're making their payments to the insurance company, but they're not yet receiving the distributions. If they then stop making payments, under law, they're entitled to get back the value, the cash value that they've already contributed. And existing law specifies that they're entitled to a minimum interest rate on whatever value they've contributed when they get that back. Under existing law, that minimum interest rate is 1%. The proposal here is to decrease that interest rate to 0.15%. This was a proposal that was offered in House Commerce, I believe, by Chuck Starrow on behalf of AIG.
And the committee all got a copy of Chuck's email that came in today.
Great, great. So he explained his reasoning. It is consistent with a model law that was adopted by the NAIC, National Association of Insurance Commissioners, although not unanimously. There was some concern raised. I'll let Jill speak from the department's perspective, but ultimately what the House decided to do is, if you look in section 33A, what they did is they made the statutory amendment effective in July of 2022. Before that, on January 15th of 2022, they've asked the commissioner basically to submit a report with any findings and recommendations on this proposal. So you'll have that report before the proposed amendment takes effect. But that's pretty much the nutshell of what's being proposed with respect to the annuities. And I will stop share.
Okay, so we've got a DFR report.
Yes, and were you able to see that screen share, or did that not?
No, we can see it.
Oh,
I've
good.
got it on my other screen, and I'm also trying to take notes. Okay. So DFR,
Madam Chair?
Yes, Jill.
Do you want Jill to go first and then questions?
Yeah, let's have Jill go first.
Thank you, Madam Chair. This is Jill Rickard, Director of Policy for DFR. Maria, your screen is still up. I don't know if that's what you're intending to do.
I'm going to try to get out of it.
Okay.
Sorry.
No, that's
Thank
okay.
you.
I just didn't know if you knew it was still up.
No, I thought that was the case, but yeah.
This is, as Maria mentioned, a proposal from AIG. DFR does not oppose this, but we also are not taking a position of support at this point. We're neutral. We understand the request for the change, and we understand that it may have market impacts if this change does not go through. So as Maria mentioned, there is currently a floor of 1%. The Treasury rates, of course, have been historically low, down to 0.2%, 0.1%. The insurer request to lower this is because they are basically paying out more interest than they're making from their bond investments when people are forfeiting their annuities. And the suggestion is that since these are very conservative investment vehicles that some Vermonters do really appreciate, they are not, I don't think anybody purchases an individual deferred fixed annuity to make a lot of money. It's to guarantee a lifetime income. And the suggestion is if the artificial floor is set at 1%, then insurance companies may not continue to offer these products if they are not sort of feeling that's a risk they want to take because the interest rate environment is so low. So that would also be our concern. We requested, though, a year to delay implementing this so we can look at the potential market impacts versus the potential consumer impacts. So that is the reason we would report back in January after taking a closer look at this. And then depending on your decision, it would go into effect in July.
Okay. So that will come back in January and this will go in July. Okay. Senator Hardy.
Thank you, Madam Chair. So my question, I don't know that I fully understand what this provision does, even though I skimmed through Mr. Sturo's letter and heard what you all just said. And so it seems a little strange to me that we would put something into law, even with a delayed rate or delayed effective date, and then wait for a report. Can't we just do the report and then decide after you come back to us with a report, and then decide whether we want to put it into law? It's essentially the same thing, but I feel like this is setting us up for, what we just heard, where people assume we've made a decision and then come in and yell at us about it. And I'd rather get the information first and make an educated decision. And with the report coming in, there's a commitment that we would take it up. So can we just do the report language and not the actual implementation of the thing, even with a delayed effective date? That's my preference.
Okay. Jill, Maria, was there a reason this had to go in before the study?
No, actually, House Commerce voted out the amendment without the report initially. They voted out the full committee report, which then went to Ways and Means and Appropriations. In the meantime, they had further discussions and I guess heard from other folks and decided to offer a floor amendment, which then added the report and the delayed effective date. So I think it just had to do with, first they were going to go ahead, then they decided to pull it back a little bit. In terms of Senator Hardy's question, you can do it either way. I leave that up to you. If you prefer not to have it on the books, even with the delayed effective date, that's your choice. But I think that's just how it evolved. I guess there are different reasons for maybe wanting to have it become effective without legislative action. That just has to do with where you want the burden to fall on the legislature, and that's a policy choice for you.
Okay. The other thing that is at play at this is that the very time sensitive separating the insurance market. So if we can concur with further proposal of amendment, which would be to leave in the study and strike it. All of which would slow it down, which we can do, but just so we know everything that's at play at this one. And Senator Sirotkin.
I was going to say the exact same thing as Senator Hardy.
Okay. So Jen, why don't you tell us about, did they do anything to market separation?
No, they left the market separate. I mean, they put the market separation provisions in, but they have it just as you voted it out of the Senate, including taking out that language about DFR doing the separate form review. So
okay,
that is in as a new section. And then there are a couple of other new healthcare related sections as well.
Anything to do with health insurance?
Yes.
Oh, well, then we better go through those.
All right. Do you want me to put that language
Yeah,
up?
why don't you put that up and I'll find it on my screen here.
Okay. This is it. Yes. All right. All right. So we have it's sections 31 and 32. 31 adds is actually similar to language that you looked at in a bill from that came over from the House last year around dental insurance. It has a new chapter on dental insurance. But the only provision that's actually in that, aside from the definitions, has to do with fees for covered or non-covered dental services. And it prohibits the insurer from setting the fee that the dentist can charge for services that are not covered under that insurer's plan. Effectively, if the
I remember the discussion, but I have
right.
This was an H bill, so I have a
an
feeling
H
we
bill.
did not get it out last year.
That's right.
Okay.
So that is this section here. Again, it just says the insurer can't set the fees that the dentist can charge for services that the insurer is not covering. And then section 32 adds what had been a provision that was part of that bill that you looked at last year and was in this dental bill as introduced on the House side, but was separated out and applied more broadly. And it has to do with payments from insurers to providers, healthcare providers. And it starts out with some definitions. It prohibits health insurers from requiring healthcare providers, and it specifically includes dentists and ambulance service providers as some of those healthcare providers, prohibits the insurer from requiring the provider to accept payment by credit card. So not what the patient is paying to the dentist in a copay or something, but what the insurer is reimbursing for the services, unless the healthcare provider has opted in, has affirmatively elected to receive their payments that way. And if the provider has not opted in, then the insurer has to make payments to the provider in another way. And the testimony that was heard on this, and DFR is the one who asked for this to be broadened beyond just dentists, is that there are fees associated with the use of these virtual credit cards when the provider gets paid. So it reduces the amount of the payment to the provider if the provider is getting paid by these virtual credit cards. And so this would put the provider in the driver's seat of deciding whether they wanted to get paid in that way or not.
Okay.
And then section 34 that we talked about is this separating the individual and small group market. There was so I'll just take you to the effective dates as well. In part, there was a floor amendment on this as well. So for the dental insurance piece, the insurer not setting the fees for non-covered services, that would take effect on January 1st and kind of roll out as contracts were entered into on and after that date, but not later than January 1st, 2023. And then that opt-in for the credit card payments would take effect on January 1st, 2022 as well. So some insurers asked for additional time to get their systems or to get alternate systems ready.
Okay, and as I remember, the dental is an NCOIL model law, I think. And that was a long time ago when I was going to NCOIL. because I wasn't on this committee for a number of years, but that's insurance legislators. And the issue was, if the one state was Rhode Island, where one provider had 3/4 of the insurance market. And so probably state employees here, if you provide state employees dental, you have, at least in central Vermont, a large portion of the market. And so they would go in and they would say, okay, we cover fillings and we cover this and that. However, the added benefit you're going to give our people is that you're going to have a reduced price on things like whitening. They were usually more cosmetically oriented services, but the kinds of not essential services that the dentists were actually making a profit on. And so that this request has been around for quite a while. I remember we had a discussion. I remember Senator Sirotkin had just come back from the dentist and loved his insurance provider. But I don't think we ever got to.
No, I had a problem with this because I thought this was a way to keep costs down for consumers. And I did have conversations after the bill died with the Dental Society and with several dentists. They were very straight with me and very respectful. The poster child for this was nitrous oxide for pediatric kids as a non-covered service, that at the time you're getting a tooth pulled or a cavity filled, the dentist adds on nitrous oxide. So the insurance company keeps the cost down on the thing they cover. But then if this law passed, which I understand it's passed in any number of states, they could potentially raise the fee. So a service that seems partially not covered, but really a lot of times comes as a package, all of a sudden goes up for the consumer. And I wanted to ask Jill Rickard a question. As opposed to not charging, this bill says that the insurance company can't set rates for non-covered services, which in principle makes sense to me. But it opens the door to fees going up potentially a lot. Why can't we say that dentists can complain to DFR if they feel the rates that are being allowed for non-covered services are unreasonable, as to opening the door wide to letting them charge whatever they want for a non-covered service?
I think they can charge whatever they want now.
Not according to Dental, not according to dentists. That's why they want the bill.
Well, if they work a contract, but I don't think that dental budgets go through state scrutiny. I have 3 dentists in my family. It's a different world. And I remember when we did Dr. Dinosaur for dental, there was a lot of concern because a lot of families switched over to it and dentists were losing significant amounts of money. And we are having trouble recruiting dentists in this state. So there's things at play. And right now, if there's any, we've got an up or down. And we've got 15 minutes to do electric vehicles. And I think what we're going to ask for is, and knowing we're putting our foot in it, is a committee of conference. Unless we can find some time tomorrow. I'm looking for my agenda now. to have this discussion because they also want us and tomorrow, I have a hard stop at 4 o'clock tomorrow. Okay, and at 2, we've got okay. I think we'll try and put this in tomorrow and we'll just move back the accelerated community broadband 360 discussion by 15 or 20 minutes. We'll get Jamie Thean in here and the healthcare advocate. Would that work? Tomorrow at 2, we've only got one at 1:30, so maybe a little earlier than 2, and we'll continue this discussion. Does that work?
Who's Jamie Thean? I'm sorry.
He represents the dentists. He's
Okay, thanks.
Prim and Piper, right? Prim, Piper and something. He's represented them for as long as I can remember and is been, you know, the prime advocate. We did try and get dentists in and had trouble because they're working while we're working.
There was a dentist who testified in House Healthcare, if that's useful for anyone to look at.
Look at that. I thought we had gotten one in, but that
And then
was some
Chuck
time.
Storrow represents Delta Dental, and they had also testified in the House.
Okay, so Faith, maybe we'll see if we can get Jamie and Chuck and Jill, if you can join us, if you have anything to contribute to this one, we'll take a look at it. Okay, thank you. We are going to move on to, wait, no, I was looking at Thursday's agenda, so it may be Thursday. No, we can put them on at 2:30 tomorrow too. We are going to move on to H433. This is the transportation bill. We had all kinds of people that wanted to testify, but we were running really tight. So Anthea is here to tell us what that bill does, and Riley is here to tell us if there's any real issues. If there are issues, we will take more testimony. If there are not issues, we won't. So Anthea, it's yours.
Okay, so for the record, Anthea Dexter Cooper from the Office of Legislative Counsel, and I'm here today to talk to you about one section in the T-bill H33. In the most current draft is section 26, but it was section 21 when they first started working on it.
Oh, they've been busy.
Things moved around. So generally what this section does, and this is a proposal that came from the administration, an iteration of this language has been in the T-bill from the very beginning. And this section is going to require, if you include it or recommend that it be included, that the state's electric distribution utilities engage in rate setting and offer PEV rates not later than June 30th of 2024. So the acronyms.
What are PEV rates?
The acronyms that you're dealing with here is PEV stands for a plug-in electric vehicle. That's going to be your plug-in hybrid electric vehicles, the one that can take gas and electricity, and your battery electric vehicle or your all electric vehicles that they just run off of electricity. And EVSE, that is electric vehicle supply equipment. And that is the technical term for a charging station. So these are rates that would be available to charge PEVs through electric vehicle supply equipment. And it would be both for public and private, the private at home charging. The rate setting would go through the normal PUC process under 30 VSA section 225. The reason why in subsection B, you see the word offer highlighted, the language that made it out of the House and the Senate Transportation Committee is considering says implement instead of offer there. It was a recommendation from one of the electric distribution utilities that it is not a requisite that a customer actually use the rate, just that the rate be offered. They have suggested a change from implement to offer that I believe the Department of Public Service is supportive of. So subsection A, your general goals. Subsection B, your timeline, offer by June 30th of 2024. Balance of subsection B is going to be, what are these rates actually supposed to be encouraging? And they're supposed to be encouraging efficient use of PEV loads consistent with some technical language that Riley can tell you all about, participation in the PEV rates, travel by PEV relative to available alternatives, and greater adoption of PEV. So you're dealing with two pieces here, the grid management and the regulatory side, but then also just trying to get more people in this form of transportation. Subsection C is the approval process and what needs to be considered. Subdivision C1 is telling the PUC that they need to approve PEV rates that at a minimum support the greater adoption of PEVs, adequately compensate the users of PEVs for the value of grid-related services, including costs avoided through peak management, and Riley can tell you all about that, adequately compensate the distribution utility and its customers, both PEV and not PEV, for the additional costs that are directly attributable to the delivery of electricity, include a reasonable contribution to historic or embedded costs, do not discourage EVSE available to the public, and do not have an adverse impact to ratepayers that are not using the PEV rate, whether by choice or whether because they just don't have a PEV to use under the rate. And then subdivision C2 gives you the other path to approval. The PUC may approve PEV rates that utilize direct load control, third-party managed load control, static or dynamic time varying rates, or other innovative to accomplish the goals set forth in the overall goal for the whole rate setting. And again, Riley can tell you what all of these technical terms mean far better than I can. Subdivision or subsection D, this is sort of a grandfathering provision. This is allowing the electric distribution utilities that have already started the process and have PEV rates that were approved prior to July 1, 2021 to continue using them as tariffs, so long as it's just for the relevant rate classes, market segments, or customer segments in which those rates are offered. Almost done. Subsection E, this is the process by which the PUC can grant an extension if need be, and the criteria that is looked at in determining whether or not an extension should be granted. And it would need to be if the electric distribution utility is unable to meet the implementation deadline because of a technical inability or because of adverse economic impacts to ratepayers. And then subsection F is going to be your reporting requirement coming back from the PUC in consultation with the Department of Public Service on how this implementation is going, whether or not the goals that are delineated throughout are being met. And that is an annual reporting requirement in January, on January 15th of each of the years between now and just after that final adoption deadline. So 2022 through 2025. I know that was very, very quick. You know, you are short on time. I will stick around for questions, but I think all of your questions can be answered by Riley.
Okay, Riley. Senator Pearson, you had a question?
Yeah, just to help me understand here, is this charge to create a charging rate? Is that sort of location specific, or is it meant to cover, you know, a public spot and a business spot and my home charging? And you know what I mean? Is there a delineation? I mean, we just buzzed through it, but
Yeah.
I didn't see that.
There is not delineation in this language, except for the fact that it is covering both public and private electric vehicle supply equipment. So it would be covering all the rate setting. And if an electric distribution utility wanted to offer different rates in different ways, it would need to meet these requirements in the PUC approval process. But it is not targeting a particular type of charging through this language.
And depending on the rate, does the rate have any bearing on the tier 3 calculation? Or maybe you're not the right, it's not fair to ask you that, but are they linked
That
at
one to
all?
Riley.
I think I'm gonna let Riley just take first crack at that one.
All right, thanks.
Okay, any other questions for Anthea? Okay, Riley.
Okay, so for the record, Riley Allen, Deputy Commissioner of the Vermont Department of Public Service. I know I'm short on time, so I'll try to talk quickly and be brief. From the department's perspective, this is an important piece of legislation. It's a little unusual for to essentially invite legislative activity on rate design. Rate design is a complex area, and it's generally best viewed as dealt with at the Public Utility Commission level. And in fact, this is really what we're proposing, is that the meat of this proposal be dealt with by the Public Utility Commission, but there be broad guidance established so that all of the 17 electric distribution utilities are essentially brought on board and encouraged by a date certain to establish rates, electric vehicle rates, and like a chance to explain why that's so important. What is the problem that we're trying to fix? I know that's a question that we often ask. The problem that we're trying to solve here is that these loads are kind of important loads, for environmental reasons and for really the cost of transportation reasons, but they're also important from the standpoint of their impact on the electric grid. If you were to, in essence, kind of flip a switch overnight and say all roughly 600,000 vehicles, internal combustion engine vehicles in the state were to become electric, it would add, I estimate, around 40% to the electric load. And that sounds like a lot, but the potential problem with electric vehicles is kind of larger than that. It's magnified by the fact that the charging patterns of people tend to coincide. That is, when people get home from work or their daily activities, they tend to plug in at a certain time of day. So it's not, if it were just kind of smooth over 24 hours, that would be challenging, but it's a challenge that our system can more or less handle. The problem is that the loads really need to be managed. But the silver lining here is these loads are just incredibly flexible. They're more flexible than any other load that we've ever seen. Average household essentially drives around for less than 2 hours a day, about an hour and a half a day or less. And then they have essentially 22 and a half hours to kind of figure out when to recharge. And typical recharging can take anywhere from a half an hour to 2 hours for the vehicle, depending on the character of their charging pattern. So there's a great marriage of opportunity. It's important before electric vehicles come on that we essentially address the challenge and get the utilities to kind of have this clearly in view so that we can manage these loads so that we avoid what I'm hoping to avoid, which is a significant buildup of our wire system to accommodate these loads, both at the distribution system level and at the bulk transmission level. So I'll pause there. I could go into a lot more detail, but I know we're running short.
So basically what this is doing is it's telling the PUC and the utilities that these are the state's goals, which is to encourage electric vehicles and to make it affordable to charge them. I probably missed something in there. And that's to be guidance as they go through the rate setting process that they go through.
Yes, and it also requires that all 17 distribution utilities offer a non-mandatory rate, so an optional rate for consumers to rely on, added presumably a discount, but to be offered an electric vehicle rate, a flexible load rate that they would be in essence compensated for in some measure
So they could offer a lower rate at midnight
That's
unless
right.
everybody plugged in at midnight, and then
That's
it might
right.
be noon. Okay.
Yeah.
Committee.
Or Riley, a lower rate on a day when there has surplus solar being generated in the afternoon?
Yeah, that's a good point. You know, what is a low cost today is in the middle of the night, but in the future, it may be kind of best recognized that the lowest cost period may be when the sun is shining and taking advantage of that. Yes.
Okay. Senator Sirotkin, or is it Senator Bray? I saw. Okay, Senator
Yeah, I would,
Bray.
since this has a lot to do with electric use and energy policy, I would encourage the department in the future to include the energy committee in the discussion. And if we could just change the reporting so that as this rolls out, that a report comes back to natural resources and energy, so we can, because this has been one of the pieces that the committee has been trying to help manage, and we've not been quite allowed to get our hands on the transportation load. And so I don't want to disadvantage us in that conversation. It's also, as everyone in this room knows, it's the largest source of greenhouse gas emissions. And so it's particularly of environmental concern to get a handle on it. It'll be interesting to see how it goes. My understanding is that GMP's take rate on this special rate for EV charging is only 15%, and BED's take rate is only 13%. So I don't know if that will change over time. There's different reasons, I think, in that it's lower than I would have guessed. But we'll see how it goes over time.
So senators, because some of us are due at a training 3 or 4 minutes ago, we don't have this bill. It's in the transportation bill. Can I tell, I guess I have to do Senator Perchlik because the chair doesn't do emails, that finance has no objection to this, but that any report back should also go to the Committee on Natural Resources and Energy? That's
my one controversial edit.
With one controversial edit?
That's all I'm saying. That's the only edit I'm asking for.
Okay.
Could I just,
Yeah. Senator
Riley,
Pearson.
is there a tier 3 implication, or that's separate from the rates?
I view that as separate. It could potentially be pulled into that in some way. I think that would be part of a tier 3 engagement between but this is a mandatory requirement that is independent of tier 3 from my standpoint.
As I understand the tier 3 connection, for instance, the difference between BED and Green Mountain Power is Green Mountain Power was offering a tier 2 charging station that would allow them to determine whether or not you were charging your vehicle and also to disconnect. And they're putting in that's a tier 3 investment, that charging station. Is that correct, Riley?
That's
Whereas
right.
BED is not providing any such support. So you would think their take rates would be very different, because the customer has to go out and spend about $1,000 to do a tier 3 charging, a tier 2 charger at home in BED territory, which means you got to save a lot of electricity for quite a while to pay off the $1,000 investment. So in one utility, it impacts tier 3, and the other one, it doesn't. And so we've got these interesting experiments in the real world running out there.
But that's the charging equipment, and
Right.
The rate design overlays on that.
Right.
And so I agree that the charging station issue is an overlap with tier 3. I don't, it logically extends the rate design, but it's not a direct connection.
Right.
I'm going to take one quick question from Senator Hardy, and then at least 2, I assume Senator Brock is minority leader, you have to go. And Senator Sarati, yeah, there's at least 4 of us that have to go because I tried to keep you to continue today and I couldn't.
Okay, I have a yes or no question for Riley. I
Great.
heard you say that something about there shouldn't be too much legislative input on rate setting. So I don't remember the exact phrase you said. So, but I just wanted to make sure, do you feel like this language provides the right balance between legislative direction and input and it doesn't overstep?
Yeah, I think this really provides the right balance.
Okay, great. Thank
Yeah.
you. Then I'm fine with it.
Okay, so committee, I'm going to tell Senator Perchlik that given what we know, we do not have a problem with this bill going forward, with the exception that any report back should also go to the Committee on Natural Resources and Energy. All right.
And I can
Thank
get that
you
written up.
all. I will email Senator Perchlik once I resume. That's a new word, resume.
Resume. Unzoom.
We'll see you all tomorrow.